I want to go over some of the textbook problems. We'll do that kind of together, talk about them. Two, I think we'll do some of the CPA review questions. And then the third, I keep putting this on the agenda every week and we don't get to it, but sampling overview handout. But, oh, I think today we'll get to it. Okay. So that's what we're going to do today. And I'm going to learn how to use my computer. All right, so I think the first thing we'll pull up, I actually sent out a handout for some of the problems we're going to do today. We're going to do problems 2- we'll talk about 2-52. There's one thing I want to cover on that. And then also so this one, hold on, let me put it on the screen. Answer sheet to the problem. Now you guys did, at least most of you did, the problem from last week, 2-52. And the only thing I want to put on there is it asks for what are the standards for B. The AICPA, oops, hey, they issue auditing standards. And the PCOB, they're called Statements on Auditing Standards. So they asked what the standards were for those two. That's what they're kind of looking for. Not obvious, but so these standards would be the generally accepted auditing standards for each of those. Let me put it up here. So this would be the generally accepted auditing standards for each of those. So the AICPA for the B for the non-issuers, which most of you guys got. This is for the non-issuers. You guys probably spelled it correctly though. All right, and this would be for the issuers. So the generally accepted auditing standards, if you're doing it for the AICPA, it'll be called auditing standards. For the PCOB, they'll be called statements on auditing standards. Yeah, so anyway, that's just for that one. Most people got this one, at least the AICPA and the PCOB, right? But the actual standards they're looking for are these. And those would be considered the generally accepted auditing standards. Those would be what we list in the auditor's responsibility in the audit report, which we went over weeks ago. One probably remembers. Okay, I want to talk about C though. We didn't talk about, but I want to go over it. And C is, there's the idea of, well, who's auditing the auditors? You know, the auditors come in and look at everybody's work. Well, who's checking on their work? You know, that's a valid question. And so they actually have set up for quality control. They have reviews of the auditor's work. Now, if it's AICPA, or you know, if you have non-issuers for clients, the AICPA, they require a review by so peer reviews. So if you're an audit firm, you'll get a review by another CPA firm every 3 years. So another CPA firm will actually come in and they're going to look at your work and see if your work is up to the standards. So it's another CPA firm coming in to review the work of a CPA firm. So it's one CPA firm auditing another CPA firm. And that is done every 3 years. And if they find problems, they, just like a regular audit, you're expected to clear up those items, you know, how you're going to rectify that situation or whatever it is going into the future. So it's an audit of the auditors, and it's literally another CPA firm coming in. The PCAOB, so this is for the issuers. Any question on that one, on the peer review? So if you're a member of the AICPA and you do audits, every 3 years, you have auditors come in and look at your work. And by the way, you have to pay for them, just like the people pay for an audit. You have to pay for them to come in and audit your work papers, audit your work. Okay, so inspections. This is a little bit different. These are by the PCAOB. And this is PCAOB oops. PCAOB employees will inspect the work of the registered CPA firms. So it is not another CPA firm coming in. This is worker, you know, some of them working for the PCAOB, they're highly trained and all that. And I imagine they're virtually all CPAs. But anyway, they're employees. It's not another CPA firm. It's employees of the PCAOB. They will inspect the work of the registered CPA firm. And you say, how often does that happen? If they have 1 to 100 clients, it happens every 3 years. If they have more than 100 clients, every year. I should say that if they have issuers as clients. They're only looking at the audits that they that they have jurisdiction over. So if you have 1 to 100 clients, it's once every 3 years you'll have an inspection. If you have more than 100 clients, 101 plus, then it's every year. And again, this is not another CPA firm. This is the PCAOB people coming in and inspecting it. Now, most of your firms are going to be in both of those. A lot of your larger firms, I should say, are going to be in both of those groups. One of the things that the PCAOB requires is that they basically become members of the ACCT330 professional organizations. So you may very well have both, or you've been another CPA from every 3 years, and then also get inspections either every year, every 3 years, depending on your size and the number of clients you have. So this is kind of the idea of how do how do we know that the CPA firms are doing what they're supposed to be doing? And this is one of the assurances, this is one of the quality controls that they have, is that they have reviews and audits. Any questions? Okay. We're going to go to problem 254. I want to go over in the book. I want to set it up first, though. And this is something, I probably should have put this in the everyone handout, but basically all the accounts that we use in accounting pretty much come down to these 5 categories. The income statement, revenues and expenses, what comes in, what goes out. You may also have gains and losses in there, but the idea is the same. This is what's coming in, this is what's going out. And the balance sheet, these are assets, and they equal our liabilities plus our equity. These are all the stuff that we own, and this over here is how we got them. How much do we borrow? How much do the owners kick in? So basically, it's kind of amazing that everything in accounting pretty much goes into those 5 categories. All right, now of these 5 categories, which one is probably the easiest to prove?
Would it be assets?
Yep. Yeah, assets are probably the easiest to prove because, buildings are assets. It's easy to, you at least prove they exist, right? Here's the building. You have inventory. Inventory's assets. Cash is an asset. You have bank statements and that. Assets are the easiest to prove. So because they're the easiest to prove, that's usually where auditing starts, is with the assets. And then next we move over to liabilities. So we start with the assets usually, go to the liabilities. Now, if we can prove right or wrong for the, whether these are materially misstated or not. If we can do that for these 2, so we can verify that this is not materially misstated and that this is not materially misstated. What does that tell you about equity?
That would be the next one to prove.
Yeah, well, it kind of already is, right? I mean, if these 2 are proven, then this one is pretty much proven also, right? If these 2 are, okay, then this one probably is too. So yeah, so we do kind of work around, but you're right that that would basically prove that one, and then come over here, and so this is kind of how we do an audit. Now let's take an account. Oops. And let's change this back to. Okay, let's take cash. A lot of times when we do cash, we'll audit it 100%. For the very reason that we usually can, and that you can get bank statements. So getting information on cash is usually it's not that big a deal. You get bank statements and you'll have them sent directly to the auditors, and it's not too tough to do that for most places. So cash is one of those things that we can audit 100%. Cash is also a while dollar wise it might not be that big on the financial statements, it actually has virtually all the transactions at some point usually run through it. I mean, you have to really think hard to find a transaction that doesn't go through cash at some point. You could, if you exchange land for stock or something maybe, but for the most part, virtually everything goes through it. Okay, now, what am I doing here? While you're proving the cash, though, everything that's going in and out of cash, at the same time, you can be proving revenues, right? I mean, if you get cash receipts in, those will end up in your cash account, and that'll also prove those, verification of those revenues you earned that cash came in. Also, if you're paying expenses, those are going to go through cash too. Let's do. Oops, too far. Hey, turn you back. Also, you say, okay, well, sometimes we don't get cash for our revenue. Sometimes it's accounts receivable. Okay, well, accounts receivable is going to end up going through cash. And same thing for the expenses. You say, well, sometimes the expenses, we don't pay them right away. Okay, well, it'd be an accounts payable, right? So while you're going through cash, you can verify a whole bunch of other accounts, a whole bunch of non-asset accounts, right? I mean, you're verifying cash, which is the asset, but at the same time, you can actually get quite a bit of verification of many of the other accounts, that are going on. So one of the reasons why we also beat up the assets is that, especially when you think about the cash account, they're tied to basically everything. So this is one of the reasons why we do the assets first, and that's why we focus on the assets and move over to the liabilities. And again, if we can prove these two, it pretty much means this one's okay. It doesn't necessarily mean, they could still change the revenues and expenses. They could overstate the revenues or the expenses, but the income is going to have to be the income ties into the equity section. So they can't get too crazy with this if these two are, if these are all okay. So anyway, that's kind of how we do auditing those. We start with the easiest thing, which is the assets, and then we move to the other accounts. Okay, let's go to next. go through the side of my head. No, let's go to problem in the book. So we're going to do problem 2-54. Okay, let me see if I can. All right, so this is what we're looking at here. And you need to take a look at, read that for a second, and we'll go through some of the questions. And by the way, this is kind of how the CPA exam works. They usually don't tell you just to write down the definition. They don't say, what's the definition of this? What's the definition of that? You don't see that usually. They'll give you a kind of a real world scenario and then say, comment on this. So this is similar to what you would see on the CPA exam. They really don't get too much into the definitions. Okay, so we're going to do an audit. You go to the client, and one of the executives says the audit work should be divided among 3 staff members. One person should do the assets, another one do the liabilities, and the third one do the income statement stuff. The income and expense accounts. The income, whether they're talking about income here is revenue. Sometimes you see them called income, income type account. Anyway, so revenues and expenses. So one person does assets, one person does liabilities, one person does the income statement stuff. Okay, so that's the first suggestion. Okay, let's go to second one. It says the advertising agency is the corporation's largest expense. And there's a staff member whose uncle owns the advertising agency, and they suggest that person handle the advertising expense because they have knowledge of their complex contract with the Cooper Cosmetics. So it says, okay, the person whose uncle owns the place will have you do this part of the audit because you're going to understand it better. And we wanted to talk to you as much because you're going to understand what's going on with it. Or someone who's not familiar, we'll have to ask a bunch of questions. Okay. So let's think about these for a second. To what extent should the auditors follow the client's suggestions for the conduct of an audit? So, should the auditors do the audit the way the client wants it?
No.
No.
I say no.
No.
No, you don't let. Yeah, you're there to be an objective, unbiased and all this, and they do not dictate how you do the audit. Now, if what they're saying is trivial or the same thing you're going to do anyways, you might just kind of wiggle your eyebrows and say okay. But yeah, you do not let the client dictate how the audit is done. So generally speaking, you don't, that's not, now, sometimes you have to explain that to people. Well, I'm paying for the audit. You got to do it my way. It's not like that. It's yeah, you do not follow that. Like I say, like I said, if there wasn't any, if it was, the stuff they're talking about was trivial, or if it wasn't, if it was what you're going to do anyways, you may not make a big deal out of it, but you never let the client dictate how you're going to do the audit. Okay. Listen, discuss the reasons why the audit work should not be assigned solely to, according to assets, assigned solely according to assets, liabilities, and income statement stuff. Okay. Well, that kind of goes back to this. What's the problem with telling them just look at the assets, don't look at anything else? And you could do that. I mean, you could just do the cash account and say, okay, let me get the bank statements. Okay, here's the cash account. Okay, approved out the cash account, and then just go on. What's the what would be inefficient about doing it that way? Why would that?
I guess because you wouldn't be able to compare what the other accounts is doing.
Exactly. You're going to go through all the pluses and minuses here. Whoever's doing the liability is going to have to do the same thing.
Mm-hmm.
So when they're talking about not duplicating work, this is going to increase the duplication of work, because
yes,
exactly, we're going to prove out the asset and then do this one separately. So you get, because there's a relationship between these accounts, having one person do each area is probably going to get more duplication of duties. If the people in the revenue have to prove out all the cash ones, all the accounts receivable ones, all that, separately, it's going to be doubling up of the work for most, a good majority anyways of the stuff. So you probably don't want to do that anyways. Furthermore, it depends on your audit staff. There's some people, I'll tell you, like when I was in auditing, I was the inventory guy. Lord knows why. I have no particular interest in inventory necessarily. I think on one of the first few audits, I did inventory. So after that, and after a while, I became the inventory guy. So, whenever there was an audit, I did the inventory, and you get that. You'll get people who kind of specialize in different areas, and those are the people you want to put in those to do those, that type of work. So a lot of times, whatever the people you have working for, you can't just assign them into something they're not familiar with, is not a good idea either. And again, the overall plan of the audit is going to be something along the lines of this. So, so having them do it, putting it all together is probably not the best idea. To have them, separate out assets, liabilities, and probably going to cause a lot more work. Okay. Oh shoot, I can't do it. I can't see it. Where is it? not showing up on my screen. How can this one not be showing up? Okay. I found it. Okay, so discuss. So first of all, you don't let the client do your work or tell you how to do your work. Their idea to have that separated out is kind of wacky. And they don't know that. I mean, they may think it's very efficient, but yeah. Now, should the staff member of your accounting firm whose uncle owns the advertising agency, should they be assigned to that portion of it?
Seems like there's a conflict of interest there, right?
Yeah, you do not want that. And and this is one of those things that may make perfect sense to someone in management, but the reality is it's a conflict of interest, and you don't want to have. You do not want to have someone who has relatives with their largest what is it, their largest expense or something, their largest expense for the advertising firm. You don't want to have that because it is a conflict of interest. That there could be there's not even family ties, there could even be financial ones. You don't know what what the background is on it, of who owns what and all that kind of stuff. So yeah, you do not want to have that. And part of it comes from going into the next one. Maybe the person who would be doing that is on the up and up and say, okay, it's my uncle, but I know this stuff, and it's, I'm gonna do my audit the best of my ability. So maybe in fact they're independent, but there could also be the problem that it doesn't appear to be independent. That you don't want it to come out in court, say that, well, this guy audited his uncle's part of the, you don't want that to come out in court. It would have the appearance of not being independent, even though it may be, maybe may not even like his uncle. Who knows, he or she. So anyway, it's, yeah. So you do not want to have those kind of relationships interfere with the audit. And again, even if in fact it's independent, it certainly could have the appearance of not being independent.
Did you repeat B, the answer for B?
B, oh yeah, the reasons for the audit is not be solely. It goes back to that handout where the cash account is connected to all the other ones.
Right. Okay.
Yeah, so that you don't, you'd actually be duplicating work, because part of proving cash, you prove accounts payable.
Right. All right. Thank you.
Yeah, so while it might sound good initially when you think about how you do an audit generally. Yeah. So yeah. Is there any question on that one? All right, so that one, you guys can fill out that one and that one. But let's go to 255. And we kind of just talked about this. Independence in fact and independence in appearance. Independence in fact is that the auditor is independent. They're unbiased. They are doing the job objectively to the best of their ability and all that. So that's independence in fact, that their state of mind is that they are unbiased, they're objective. Independence in appearance is that even though they may be independent in fact, they cannot have the appearance of being it. Why? Because the only thing that auditors give to financial statements is credibility. So if the independence appears to be, violated in appearance, that's a problem, because people aren't going to trust the financial statements. Is there any question on that? So independence in fact is that they are actually, the auditor is actually, their state of mind is independent. So the auditor's state of mind is independent. Independence in appearance is that also, even though they may be independent in fact, they also cannot have the appearance of being not independent. The staff member's uncle is an example of that. They may be completely objective about it, but the appearance would be that they're not. And so, again, the only thing we give to financial statements is credibility. And if that is somehow impaired, it defeats the purpose of an audit. Okay, number 2, which of the 2 general types of relationships normally compromise independence? All right, let me go back to the... I'm going to write those. Okay, so the 2 types of financial interests and financial interests and management/employment interests. So these are the 2 types of interest that can be in, it can cause a problem with independence. Financial interest is things that are investments in the client. For example, owning, I lost my thing here. Hey, okay, make it blue. The nickname for IBM is Big Blue. So I just made it blue. So if we're auditing IBM, owning IBM stock would be an investment. There's a financial interest in it. So that would be a no-no. Number 2 can come in a couple of scenarios. It could be auditors performing management duties is one form of it, being a no-no. For instance, you may have the if the auditors are making management decisions, then that is an impairment of independence. So, for example, the company says, "Gee, we just lost our chief financial officer. Can you guys find us a chief financial officer?" And the auditors say, "Sure, we'll find you a chief financial officer. We'll go out and hire the person and all that." Hiring a chief financial officer is a management duty. You can't do that as an auditor. Now, it is possible they do, they perform a search or something like that and then say, "Oh, here's some candidates that, the company may want to look into," and then the company goes and looks in, but the company has to do the hiring. You cannot make the decisions for management. So you can't make management decisions. The company has to make those decisions and they have to live with those decisions. So the auditor cannot perform management duties. It could also be auditors working for the client. or working or are prospectively working for the client. In other words, maybe they've gotten an offer from the client to go work for them. So auditors actually doing work. It could be that they're on the board of directors. Board of directors is an oversight position, and you cannot work on the board of directors and do the audit at the same time. I know that might seem obvious. I actually had a student that had that happen. One of the people on the board of directors that owns their own CPA firm and said, I'll do the audit and I'll do it cheaper than anyone else. And they did the audit, and the bank came back and said, this isn't an audit. You're not independent. Yet they had to get a second audit. You cannot be on the board of directors and do the audit for the firm, for the client. So if I was for instance, on the board of directors of IBM, I can't, if I'm a CPA firm member and I'm also on the board of directors of IBM, I can't do the audit. We're in a oversight position, basically. It could also be auditors, relatives working for the client. You have a spouse who's an operating officer for IBM. Can you do the audit? And for this one, you generally look for people who are in key positions. For this one, you're talking about a key position. For instance, somebody who can have an influence over the financial statements. Okay, I have a spouse who's a director of something at IBM. No, I can't do the audit. I have a nephew, who is who's working on the loading docks at IBM. Well, they probably can't influence the audit. So there is a reasonableness thing here that is only for people that are, the term that they use is key positions. Oops. If somebody is not in a key position, it's not gonna make any difference. There's nothing that somebody on the loading dock can do to change the financial statements. So you're really looking at key positions when you're talking about, especially this one for the relatives that are working there. Okay, so the financial interest. Direct, you can't have any direct interest. We'll actually go into there's a chapter on this. We'll go into it. And by the way, if you're wondering, how much of the CPA exam is this? This is about 20% of the CPA exam on average. It's a lot. They'll go into all kinds of things about impairing, independence. And again, it has to be in fact and appearance. So, there's a lot in there. And a lot of things are, can be somewhat vague. It can be hard to, suppose my mother is a middle management person at IBM. She might be able to influence financially, depending on where she's at. What if I haven't talked to my mother in 20 years? There's all kinds of different scenarios you can come up with for if your independence is impaired. Okay, let's go back to the question. There's got to be a way for me to do this. Oh, new share. See, look, I'm learning. See, you guys thought I couldn't learn. I can learn. Okay, let's go back to the. Oh, look, it even shows my thing here. That was so much easier. Okay, now I learned. Okay, so for each of the following, situation and discuss whether you think the auditor's independence has been compromised. The auditor's firm provides extensive consulting services to the client. These services provide revenues to the firm that exceed the revenues from the audit engagement. By the way, this one is not that unusual. So the audit firm provides extensive consulting for services to the client. And they're billing out more for the consulting than they are for the audit. Would that impair their independence?
Yes.
It certainly could. You know, there's a problem. By the way, this is what happened with the Enron case. Enron started the Sarbanes-Oxley, which in the end, that the PCAOB, the Public Company Accounting Oversight Board, that came out of Sarbanes-Oxley, and that is all directly related to the Enron. And the Enron case was a little bit interesting in that they had these, they had a bunch of losses. Enron did. They didn't want anyone to know about. And so they made these joint ventures and they put all the losses in the joint ventures. Arthur Anderson was a CPA firm. Their consulting side set that up. Their consulting side made a lot more money than the audit did. And so, yeah, there was a problem that they, you know, and so here you are, the auditors, that they were in the position of contradicting their consulting side of the business. So it was definitely a conflict of interest. It's also possible that it's not. It really depends on what the services that they're doing are, and that if they are appropriate, it's possible that they are not violating it. So this is one of those things that's kind of a gray area in that it really depends on what the consulting is. That if the consulting is either not related to the financial statements or appropriate in that they're making suggestions to improve things, you know, for the client, that's one thing. But if they're actually consulting on areas that do have an impact on the financial statements, and that there could be a problem with the independence because of it. So it really depends on what they're actually doing. Just this information, technically, the answer to this would be that it could be fine. That it could be fine, but it really depends on what they're actually doing. So this would probably be kind of a gray area. And this also could very well compromise the independence and appearance. You know, you get the auditors doing, the audit there, but they're making more money doing the consulting than they're doing, So you do have that problem. This has already been kind of sorted out for the issuers. If you do the audit for a publicly traded company, you are very restricted in what you can do on the consulting side. They don't let you do hardly anything. If you do the audit, that's all you're doing basically is the audit. There might be another CPA firm doing the consulting, and by the way, when those rules came out that they couldn't do the consulting and the audit, most firms gave up the audit because they were making more money on the consulting side. So they would give up the audit to another CPA firm rather than give up the consulting. Okay. So again, for issuers, that one's been kind of sorted out in that you don't have that really anymore as a problem. It was a big problem in the past. Some of these CPA firms almost ran companies. I mean, they really did. Their people would all be in there. The upper management would all be from their CPA firm, and they pretty much ran a lot of companies. Okay, let's go to number 2. The spouse of the partner in charge of the audit occupies an executive position within the client. Does that compromise independence?
Yes.
Yes, that's an absolute yes. It's an executive level position is a key position, and you cannot have relatives in key positions with the client. So this is a definite. So number one is kind of a gray area. Number two is a definite. It is a violation. Number three, a distant relative of the partner within the firm occupies an entry-level position with the client of the firm. The audit is conducted by another office in the firm, which the partner has infrequent contact.
I would say no.
No. There's a few things here that knock it out. First of all, it's a distant relative. May not have ever even seen the person. Entry-level position, it's not going to matter. If you're auditing McDonald's and you have somebody that works at, got a job from high school working at McDonald's or whatever, it's not going to matter. So those two things. Furthermore, the audit isn't even done by that auditor. It's done in a different office completely. So there's really kind of three things that knock this one out. Distant relative, entry-level position, and the partner doesn't even do the audit. It's done by a different office completely. So this is probably not going to be anything. And you're talking about large companies. It'd be almost impossible to find some companies that don't have at least somebody in the firm somehow. You get these large companies. For instance, Amazon or something like that. Try to find an office with 300 people that don't have somebody somewhere working for Amazon. It'd be impossible. Okay, a staff auditor of the firm owns shares of stock of one of the firm's clients. She is not a member of the engagement. Sorry, you got to move it up. Okay, she's not a member of the engagement team serving that client.
I think this would be like a gray area.
You're right. And but here's the thing: they don't tell us how much stock it is.
Right. First
of all, if it's not a material amount of stock, it's fine. If they're not on the audit, and this is a staff member, this is not someone high up in the CPA firm. We'll talk more about that. There's actually a whole bunch of rules related to this. But so this is a staff member. This is not somebody who is, way up. And so they can't influence the audit, basically. Not a member of the engagement team. Okay, so you got the staff member. He or she, she owns some stock in, say, IBM. You're doing IBM audit. It's not going to make a difference. She's not working on the audit. She can't influence the audit. Doesn't matter. There is a kind of a rule, not kind of a rule. There is a rule that if the ownership is more than 5% of the client, that the entire CPA firm is not independent. So there is a 5% rule. Now, you're talking about IBM. If a staff member owned 5% of IBM, they'd own an island somewhere. I mean, there's no way that, especially for publicly traded companies, there's no way that that really would come about. I wouldn't think. Someone working a CPA firm that owns 5% of it, but anyway, so there is a rule of 5% that if depending on who they are, if someone in the firm owns 5% or more of a client, that the entire firm is not independent. So this would be kind of a gray area if you know how much stock that they own in it. But generally speaking, just owning stock in the firm in a client, if you're not on the audit and you're not a partner or something like that, is not a problem with it. By the way, when you go to work for a CPA firm, I think I told you this, maybe I didn't. They'll usually give you a list of their clients. And they'll say, do you own any stock or investments in any of these clients? And if you say yes, they say, oh, well, you get to sell those because you can't work here and have them, you know, they don't want to deal with it. So, you know, because they might, what they don't want to have happen is they pull you from one audit onto another one and find out that you own stock on it. That's a huge problem. It's a huge problem because it's prohibited. You can't have one share of IBM stock and work on the IBM audit. So, you know, usually when you go work for the CPA firm, they give you a list of clients and say, if you have any shares in any of these, you got to sell them. Okay. 55. What else do we have? Let's go to
6.2.
Yeah. So 6.2. I think this one has I think this is a goofy spacing in mine. Oh, maybe not. Oops. Okay, 6.2. Let's go to that in the. Okay, so these are going to be comments that are coming from the auditors, and basically you have to kind of evaluate these as far as, you know, are they on the right track or not? Okay, so, you know, basically, is the statement correct or is it not correct? This is kind of how we're going to look at it. Okay. First one. We don't need to consider the risk of material misstatement in our work because we really can't do anything to reduce that risk. Okay, and here's what they're talking about. You know, that there's a risk that the client may have a material misstatement either through error or fraud that is on the financial statements. They say, well, look, we don't have any control over that. That's the client. The client has control over it. So we don't have to worry about material misstatement because, you know, that's a risk we can't reduce. So if the risk is 5% or 10% or 50%, it doesn't matter because we have no control over it. Does that sound okay?
No.
No. You got to consider the risk of material misstatement. You know, what's the risk that a material misstatement is going to occur, because that will tell you how much auditing basically you have to do on any given account. So if there's a big risk for material misstatement in, say, inventory, well, that means that you have to focus more on the inventory. You can't just ignore that risk that there's a material misstatement in inventory. It's true that it is the controls of the client that kind of dictate that, but you assess it so that you know where to focus your audit attention on. Yeah, so you do need to consider the risk of material misstatement. The higher the risk, the more auditing you got to do. The lower the risk, the less auditing you do. Okay. Because the client has not implemented effective internal controls, we need to gather more reliable evidence. This means we need to test a greater number of transactions to obtain more reliable forms of evidence. Okay, so the client doesn't have very good internal controls. So they're saying we need to get more evidence done. We got to get different kinds of evidence and more of it.
Yeah, I would agree with that.
Yep. B is actually correct, yeah. That if you know, and here's one thing too about the internal controls. I think we talked about testing controls, didn't we? Maybe we didn't. I don't know, but yeah, if you can't rely on the controls, then you got to go to the next step, and that's just getting a bunch more evidence. Well, I shouldn't say a bunch more. It's more. You have to get enough that you get. I used to work with a guy. You say you got to get enough to get the warm fuzzies about it. So yeah, all right. C. We really need to spend a lot of time and effort on this audit. Because this client has just filed a bond offering, we can't allow for any misstatements on the financial statements. We need to guarantee the accuracy of the client's financial statements. There's actually a key word there that is kind of a no-no. Well, actually a couple, but right.
Guarantee.
Yeah, I was gonna say guarantee as well.
Yeah. You do not guarantee, you give reasonable assurance. And we don't look for any misstatements, only misstatements that are material. So look for material misstatements. We don't guarantee, you're right, we give reasonable assurance. And we also never actually say, we actually come out and say that the financial statements are accurate. We say they're free of material misstatement. In other words, they might be misstated, it's just not material. So we never, there's a few things here that are wrong with this. The only misstatements we look for are material. You do not guarantee, you're absolutely right, that it is a reasonable assurance. And we never actually vouch for the accuracy. We just say they're free of material misstatement. They might be misstated, but it's not a material amount, is our opinion of it. And again, it is an opinion. It's not a statement of fact. Now, it's an informed opinion, but it is not a statement of fact. It's not, that. Okay, let's go to D. Because this company has $140 million in revenues, we really shouldn't be concerned about smaller amounts because they are not likely to have a major impact on the financial statements.
That's false.
It actually is true to some extent. Now, you can't, you got to define this. What is a smaller amount? But for instance, they have 140 million in revenues. You find a $3,000 error, it's not going to really impact this. So it depends on the size of this. We're going to talk about this. The next chapter, either the next chapter or the chapter after that about materiality. That is, you actually define what is material. So just saying smaller accounts is too vague. You kind of have to put a dollar amount on it. But we do only look for things that are material, and that if they're not material, we don't worry about it. The question here is, what do they mean by smaller accounts? Let me tell you about a smaller account. Petty cash. By definition, it's petty. It's so usually petty cash will have maybe a couple $100 in or something like that. External auditors generally don't look at that. By definition, it's it's not relevant. So the smaller accounts, you generally don't do a lot with. Now, there is also a problem, though, and this is, I think, what you were talking about when you say, that this is not right. If they are understating accounts to make them very small, that can be a problem.
Yeah, that's what I was referring to.
Right. So they have accounts payable. Their accounts payable should be 20 million, and instead it's 3 million or 2 million, whatever. It's way
right.
It'll look like it's a small account. However, it might be a small account because it is misstated. So that is also a problem you need to be aware of.
I was also the second part was just going off as doing the due process of not overlooking simple things that should be simple.
Yeah,
sense.
Absolutely. And again, the problem with smaller accounts is that they could be understated.
Right. Okay.
Yeah, and I'll tell you one thing that is a lot. They'll have a lot of times is contingent liabilities. A company gets sued, and it's likely they're going to lose the case. You know, maybe they're negotiating, trying to negotiate a settlement or whatever, and a lot of times those are understated, and they'll get mad at you if you talk about it because they'll say, "Well, wait a minute, if you put that we owe $800,000, and the complaint, the plaintiffs is going to say, look, they admit that they owe us $800,000. So you do run into that problem of there are some accounts, contingent liabilities being one of them, that a lot of times they are understated, and they're understated. I don't want to say for valid reasons, but they're understated just by the nature of them. That a lot of times they will be understated. First of all, that they're not settled. And second of all, that they don't want it to appear to be an admission of something. So yeah, you can definitely, the smaller accounts is, now if this says smaller amounts, that would be different. Smaller amounts, if it's up by a small amount, that's fine. But you gotta be careful on that one, that it's not an understated account. Okay, E. I know it will be more time-consuming and expensive, but we are required to physically inspect the stock certificates held by the client rather than obtain confirmation from the custodian. After all, our direct observation is more reliable than receiving a confirmation.
I think I disagree with
Yes.
Yeah, now, well, what they're saying is right. The direct observation is generally going to be a better evidence. But now here's the thing about auditing. You don't always have to get the best evidence. You have to get enough evidence for whatever it is. And for instance, if this is a smaller amount of stock, it depends how big, how many, what are we talking about here? Is it material or not? So the size of it makes a difference. And but also that you don't necessarily have to get it's not that you're not required to get the best evidence all the time. And when we start talking about evidence, you'll kind of see why. You'll actually get the evidence that you can get the same level of assurance, but at the most reasonable cost. And two, one of the things about doing an audit is that you generally have your costs, and those are billed to the client. And you don't want to waste the client's money. If actually going there and physically inspecting the stock certificates, if it costs 2 or 3 times as much as having a custodian, presumably objective custodian give you a confirmation, it may not be worth it to, waste the client's money to go to get the best evidence. So this one, it's hard to know. It doesn't say the size of it, how much of it is. Is it 1% of their assets, or is it 10% of their assets? So that would make a difference as far as what you would get for reassurance on it. But there's also the idea too that you don't necessarily have to get the best evidence. And that if you have if you objectively trust the custodian, that they'll be objective and that they'll do their job and all that. It is possible to use that as evidence. So this is one of those judgment calls. It's a judgment call to say whether we need to go inspect the documents themselves, or if we can use a confirmation from a custodian.
Professor, can you explain to me a little bit when you say material? You say that quite often when
I do. I say
material. What exactly are you saying?
Okay.
What's the material?
What I mean by material, and there's generally, you generally have rules of thumb for materiality. And the definition of material is something that would make a difference to a reasonable person. And again, this is the legal, reasonable person. There actually is no reasonable person walking around. But the idea is that if you are a reasonable person, that of what amount would actually make a difference. And so, you know, well, I'll give you a rule. Let me do just an example. Okay. Materiality, it depends on how large a place is. So let's say that we have so we have total assets, and we have client A, hey, supposed to change that. Client B, and client A has, let me do something here. Client A has $1 million in assets, and client B has 60 million in assets. You know, so the question is, well, okay, they have 1 million, they have 60 million. The idea is, what would be a reasonable person? How much of this would have to be misstated for a reasonable person to, you know, to make a difference to a reasonable person? So you may have a rule of thumb, and let's say the rule of thumb is, oops, not a roll. The rule of thumb may be take total assets times 1%. Okay. Ooh. So that would mean total, what would be a material would be so material amount could be, you know, 10,000 for client A, but for client B, they have a lot more money. They have a lot more, not money, a lot more assets. So for client B, maybe is, you know, 600,000. So the ratio, you know, of these are actually similar, right? Okay, let's take a client C. Client C has assets of $1.8 billion. 1,800,000,000 in assets. So the material amount is 18 million. Now, to be honest, most CPA firms would not want to go into court and say we missed an $18 million error. So a lot of times for larger clients, they actually reduce the amount, the percentage amount. So maybe instead of being 1%, they'll say 0.5%. Oh, 59, not 50%. Let's try that again. So a lot of times, just because the dollars become so astronomical for these large companies, that they will actually reduce the rule of thumb when they get to them, because again, you don't want to have to go into court and say we missed a $15 million error or fraud or whatever. And so they will generally use a smaller amount as material. So if they're misstated by 9 million, if they did 1%, it would be 18 million, but they say, okay, we're going to go down to 9 million because we don't want to have to go into court and have to defend it. The numbers just become so large that a lot of times they'll do that. So the material amount is, again, this is all judgment. So the whole thing is auditor judgment. And that's why it can be difficult. Are you going to use 1%? Are you going to use 0.5%? What is material? And we'll find out later too that materiality can also be different depending on what kind of a misstatement it is. For instance, which is more serious, an error, or fraud. So let's say that you find you're auditing this company and you find a $320,000 error, or you find a $320,000 fraud. Which one of these is more concerning?
The fraud.
Yeah. This is someone intentionally misstating the financial statements. This is intentional. An error is, in this contract, we did this, we thought it was this, it's not, it's, whatever it is. So an error is generally going to be a less severe thing than a fraud. And the fraud too, it depends on who's doing it. If a lower level employee is doing some fraud, it's probably not that big a deal. But if you got someone who chief financial officer doing fraud, that is a big deal. Even though the dollar amounts might be the same. So again, when we say material misstatement, I understand why it's a difficult concept. It is vague because it really depends on a lot of stuff. But the rules of thumb are kind of what, for the most part, what we're talking about is, some relationship to, it could be total assets, it could be total revenue, it could be income. There's all kinds of rules of thumb out there, but that is kind of what we're talking about.
Okay, understood.
Yeah. Okay. Yeah. No, it's a difficult topic, and you're right. We talk about it all the time. Yeah. Okay. Let's take a break. What time? Like 7:17. Let's come back at 7:25 maybe. Yeah, let's come back at 7:25. And I think we come back. We'll do the. I'll let you guys decide. You guys want to do the sampling one, or do you want to do the multiple choice questions?
Sure.
The sampling.
Sampling. I tell you, you guys can vote. You can vote in the chat. How about that? If you want, I'll put the chat up, and if you can vote in private too if you don't want other people to see. Private, vote for that. So let's say be back at 7:25.
video room in the bathroom. Like, what happened? What's the issue with the floor? Why everything gotta go on the floor?
I'm sorry. Okay, now I'm on. It looks like we're going to be doing the CPA review. So, so next it's 5 to 3. It looks like. Okay, so next class we're going to start out with sampling overview. it's been bumped too many times, so we'll go CPA a few questions, and actually they kind of tie into what we just did. So we'll go ahead and pull that up. Wrong thing. Nope. Yeah. So CPA, about, I don't know, I think like half of these questions are CPA, actual CPA questions. Okay. And some of these questions are somewhat easy. Some of them are more difficult. And it's like they are the real CPA exam. The real CPA exam, they have easy questions and more difficult questions. The easy ones are worth 1 point. The difficult ones are worth 2. So some people think that they're all worth the same amount. They're not. If it's a more difficult question, you get more points for it. Less difficult, you get less points for it.
So is this like an overview for like the midterm, or is this like actual like CPA like review questions?
Some of these are actual CPA review questions. They're actually on CPA exams. A lot of this stuff goes way back. The CPA exam, I think I told you guys this, maybe I didn't. The CPA exam was an open exam until 1996, which I know is a long time ago, but so up to 1996, it was an open exam, and a lot of this stuff hasn't really changed since then. So there actually are real CPA questions floating around out there. When I say it was an open exam, when you went in to take the exam, they'd hand you the exam, and then they'd hand you an answer sheet. You'd fill out the answer sheet, hand in the answer sheet, and then you'd take the actual exam, put it in a self-addressed envelope, and you give it to them, and they would mail it to you. You'd actually get back the actual exam you took. So a lot of those questions that were on those exams are widely used. And so, I don't know, I think maybe, I didn't look, I think 7 or 8, I think there's 12 here, 12 multiple choice questions, and I think 7 or 8 of them are actual CPA exam questions. No, this isn't for a midterm. This would just be kind of, these are all kind of general.
Just like general knowledge, like
kind of, yeah, a little bit of background stuff on it. Some of them are tricky, and some of them are, are not. So, on the CPA exam, basically you have to get around 75%. That's not exactly true, because I just told you about some are worth more than others of the multiple choice questions. But if you can stick around 75%, you're usually okay as far as passing it. Okay. First one, which of the following is generally not required? So not required. So which one of these are you probably not required to do as part of the generally accepted auditing standard? In other words, the general standards for auditing. Which one of these probably are you not responsible for?
D.
B.
Okay, where's the first one? Yeah. Second one, critical review of audit performed at every level of supervision. You actually are going to do that. One of the things about doing an audit is that everything, if you're an entry-level auditor, the senior auditor is going to review your work. A manager is going to review that work. Oh yeah, we could do this. We could do this in the chat. That would be. I never thought about that. Oh yeah, actually, there's some kind of a polling thing too in here. If I do it now, I'll goof it up. But anyway, so yeah, actually, so the review of someone's work, literally, if you are a first year auditor, first year assistant, it would not be unusual to have 5 people look over your work. So they do actually look at the different levels. They'll review your work. The C, the skill commonly possessed by others in the profession. And D, the responsibility for losses because of errors in judgment. Which one of those, let's pick between those two. Which one of those two are you probably not required, being an auditor?
Would it be D?
Probably D, yeah. You're not responsible for the losses due to error judgment, by the client or anyone else. I mean, this is not your responsibility. Is to give an opinion. It's nothing to do with responsibility for losses or errors of judgment. People say, well, what about it? Talking about errors of judgment in the CPA firm. Well, that's that's not necessarily one of your responsibilities either. Okay. Which of the following best describes as the reason why independent auditors report on the financial statements? This is a tricky one.
Would it be B?
Yes. Yes, this is it. Okay, so let's kind of go through here and see why. Oh, by the way, another thing about the CPA exam that is important is that it you actually are told, you actually are told to pick. The actual instructions are to pick the best answer. So there may be more than one correct answer, but you're told to pick the best answer. This first one isn't too bad, except that it talks about fraud only. And we don't do the audit just for fraud. It's not necessarily just a fraud audit. It's for errors, it's for presentation and other things. So, well, this one isn't bad. I mean, this is certainly one of the reasons why you do an audit. There's a possibility of fraud, but it's not the only thing. The statement of accounts balance may exist and is generally corrected as a result of the independent auditor's work. There could be lots of misstatements in the balances. And we generally, if there's a correction, it's only usually for a material misstatement. And, so it doesn't say anything about materiality. And we don't catch, you don't rely on the auditors to correct all of the, misstatements in account balances, because they're only looking for things that are material. And poorly designed internal controls may exist. This is true, but you can still do an audit on it. They can still look at their financial statements. And I think I talked about before, maybe I didn't. If a company has poor internal controls, does that mean their financial statements are misstated?
No.
Not necessarily. Right? I mean, it makes it more likely they're misstated, but not necessarily. They could have poor internal controls and still have their financial statements done correctly. So even if they do have bad internal controls, it doesn't necessarily mean that they're going to get a bad audit report, because if their financial statements are fine, then fine. Operational auditing. These are kind of definition-y. I think it was in the handout. Operational audits. These are different than financial audits, and they're only looking at the operations, ways to improve the operation. For instance, like they look for effectiveness and efficiency. We don't look for those things in financial audits. We look for financial statements, whether they're efficient or not efficient. You know, we don't care too much. Well, I guess we don't. Not that we have bad attitudes, but it's not part of what we're doing. Alexis, yes. We are looking for future improvements. An operational audit is one that you actually look for ways to improve the operation, either effectiveness or efficiency. So either do something better or do something more efficient. And you know, some of these, this one is more leaning towards a financial audit. This is definitely a financial audit. And past production provided by existing internal controls, that is not past oriented, it's future oriented. It's how do we improve things from now going into the future? So, you know, the whole idea of it is not you know, shake your finger and say this is wrong or something like that. It's to say, okay, here's what we need to do going into the future to make improvements. So when I was doing internal auditing, we did a lot of that. And the biggest one I found was about $500,000. It was one of the last things I did before I got out of auditing. Okay. A typical objective of an operational audit is for the auditor to which one?
ABC.
Yep. Yeah, make recommendations to improve. Yeah. So operational audit is actually it's a little bit different. They're usually much bigger audits. You know, we're not just looking at a single account and you can see if they're or whatever. You're looking at ways to improve stuff. It's they generally take a lot of time. Passage of the Sarbanes-Oxley Act led to the establishment of the
C.
Yep. Accounting Oversight Board. And the Public Company Accounting Oversight Board, they're underneath the Securities and Exchange Commission. The Securities and Exchange Commission was made in 1931, I think it was. But so they're underneath there, but the establishment of that organization was made by the Sarbanes-Oxley Act. But the overseer is the Securities and Exchange Commission, but that was made many years earlier. The auditor's examination performed in the course of generally accepted auditing standards generally should And by the way, if you want to send the answer in private chat, you can.
Is it D?
Yes. Yeah, we don't provide absolute assurance ever. Be relied upon to disclose violations of truth in lending laws. That's not really what we're doing. That's usually a different type of an audit. That would be say a compliance audit or something like that. We don't look for all illegalities. You know, someone at Walmart working there takes a candy bar when they go to lunch or something. You know, that's not our problem. So, yeah, but not really relied upon private absolute assurance. We don't give absolute assurance. You know, illegal acts happen. You know. any given store, you're going to have illegal acts happen every day, but they're not going to be material. Okay. Which of the following best describes the audit of a taxpayer's tax return by an IRS auditor? This one's a little bit tricky, but
I want to say is government audit D.
Compliance audit?
yeah, it's actually compliance. But yeah, it is a government agency. But when they talk about government audits, they're usually talking about government agencies that are being audited. For instance, the Pentagon or whatever. Those are government audits. So it's going to be a compliance audit. Are you complying with the tax code? They're looking if you're complying with the tax code. So it's actually a compliance audit. If you're complying with the tax code, that's fine. Yeah, but so the government audits are usually audits of government. The city of Chicago is the government. That's going to be a governmental audit. Those are type of government audits. Or either local or state governments themselves or agencies of the government. Okay. An investor reading the financial statements of the Sunbee Corporation observes that the statements are accompanied by an unqualified auditor's report. This is old terminology. I should take this one out. From this, the investor may include the unqualified report is a clean report. So the unqualified report is, and it's a funny terminology, but unqualified means that we're not saying except for this or except for that. We're saying, hey, it's as far as we're concerned, that our opinion is that these are free of material misstatement.
Then it would be B.
Probably not. We
No.
don't look to see if they're efficient.
Efficient. Okay.
Yeah. If it says the effective of the effectively, over it. Of their, we do look to see if they're effectively free of material misstatements, but we don't look for efficiency generally. If this was an operational audit, you would.
Would it be D? I think that.
D?
Isn't it just focusing on the financial statements?
Okay, now this will not necessarily the footnotes are. We actually do report on the footnotes. That is part of the. Actually, it's part of GAAP. The footnotes are required, so we do require the footnotes. C is a tempting one. However, do we give any assurance that they're accurate?
No.
So that that tells us this is the one. Any disputes over significant accounting issues have been settled. This is one of those ones that is, you're looking for the best answer. So we don't, the company may be inefficient, but that's not our responsibility. That's for the investors to figure out. We generally do not use the term accurately. The only time we use the term accurately is when we're talking about an individual transaction. That any individual transaction, there is the assertion that it's accurate. But that's only at the, that's at the transaction level. We don't say that the financial statements are accurate. We never give that type of assurance. We say they're free of material, reasonable assurance, but whether they're free of material misstatements. And again, it's reasonable assurance. And the footnotes are required. There's more information. Most times there's more information in the footnotes than there are in the financial statements. Okay, if an illegal act is discovered during the audit of a publicly held company, the auditor should first
It will be C.
There's something that knocks C out of it.
You have to report it, right? Correct. D?
Yep, it's D. Yeah, we don't look for all illegal acts. And by the way, when you're taking a CPA exam, you got to really pay attention to when they say all, or that we say that you have absolute assurance and all that kind of stuff. Those are key words that they throw in there to knock that one out. So we don't look for all illegal acts. So someone, so an employee grabbing a candy bar, stealing a candy bar and going to lunch, whatever, is not. We don't look for that. And also remember that we're there to look at the financial statements. So generally speaking, we're not there to determine who's responsible for it and all this kind of stuff. We don't go running to the authorities. We generally let the management take care of it. Now, there is a problem. It depends really on how high up it goes, how high up the illegal acts go, and how severe it is. If it is material, and this is for a publicly held company, this is maybe getting a little further than this question really goes into it, but if it's a publicly held company and it's material, you generally, if you report it to management, they have 24 hours to act. So management has 24 hours to act on it. And if they don't, so let's say it's material. Management has 24 hours to act. I should say to act. So if it's an illegal act, they have to contact the authorities. If they don't do anything for 24 hours, and I'm sure you'd let them know this. Say, look, you got 24 hours to do what you need to do, and if you don't, we're reporting it to the SEC, and the SEC will take care of it. So it's publicly traded. If it's not publicly traded, it's a bigger can of worms. If it's publicly traded, you are required to report it to the SEC within 24 hours if they don't do anything. If it wasn't publicly traded, you found material, something that's illegal and it's material, you probably end up getting a lawyer saying, okay, what do we do now? Because you have a fiduciary duty to the client. You can't just go running to the police department and start pointing fingers and stuff. You have a duty, fiduciary duty to your client. So you probably end up getting a lawyer. I know that doesn't sound very like a very good answer, but that is the answer. But if it is publicly traded though, they got 24 hours. If they don't act on information, go to the SEC. And you have to go to the SEC on it. If you don't go to the SEC, you're going to be the one in trouble along with the company. All right. The primary responsibility for the equity disclosure of the financial statement of the publicly held company rests with who's responsible for the financial statements? This goes back to that audit. We probably should have done these right after we read that audit report. Okay, first of all, let's say who's not responsible. The auditors are not responsible for financial statements. Why? We don't make them. We're responsible to make a report on the financial statements. So who is responsible for the financial statements?
Management.
Yep. Management is responsible for the financial statements. Our responsibility is to issue an opinion on the financial statements. So the financial statements are management responsibility. Our responsibility is to make an audit report. Okay, 11. Which of the following types of services is generally provided only by CPA firms? A little bit of a tricky one.
Operational audits.
Actually, anyone can do these.
Oh,
Yeah. Compliance audits and tax audits are kind of the same. This is it, the financial statement audit. So financial statements can only be done by CPA firms. Tax audits can be done by IRS people. They don't have to be CPAs. Compliance audits can be done by other people. Operational audits are often done by people who are not CPAs. Operational audits could be in computer design. It could be all kinds of things for operational audits. So the only ones that are actually only for CPAs are the financial statement audits. Okay. The right to practice as a CPA is given by which of the following organizations?
AICP.
Nope.
No? Oh, sorry. The state of
The state boards of accounting.
Yep. Yeah. Hey. The state. It's a license. It's like a driver's license. Okay. Yeah, so those are, I mean, going through these are kind of, I would say, somewhat typical. Again, some of them are, and by the way, you'll get when you're taking your review for the CPA exam, you'll get used to reading these, and you'll get used to keywords that either kick out an answer or whatever. So if it seems kind of strange going through these now, once you start studying for it, you kind of get the feel for it, so to speak, of the answers to them. Okay. Question on that? All right. Let's see. For next week.
Are these already listed on our notes, or in the tabs under the course?
This.
What we was just working on. Mm-hmm.
This.
Mm-hmm.
There'll be a drop for the one problem I assigned last week. That'll be separate. 2-52. I'll put a submittal thing on for 254, 255, and 262.
Okay.
I'll put those on tonight. This one, I'll tell you what I used to do with this one. And maybe I think in the future I'll figure out a way to do it for the multiple choice questions. I used to have these done in groups, and the groups would get extra credit points. You need to talk it over and all that, which I still think is a good idea. And I don't mind. I think I might do something here with the polling, so that you guys can actually go through here and put in your answers and get multiple and get extra credit points added onto your exam from it. I'll put this on there. I'll put this on as an assignment. And like I say, in the future, I think I'll make it a little bit more, let's say profitable, but I'll make it a little more interesting by giving extra credit points to the class, and we'll have voting. We'll do it by vote, and I'll get it set up so that we have it. I think there's a polling thing in Zoom, so I think there's a polling thing, and I also know that I don't know how to use it right at the moment, so I will figure that out. I should probably give you guys a test on this. I'll send out a think here. I'll send out a test. I'll get it out by tomorrow. I'll send you guys a test tomorrow, and we'll make it. I'll make it due by the end of next week. But I'll send out a test on chapter 1 stuff. It'll be stuff similar to what we have here, it'd be mostly essay. I think maybe 100% essay. I'll take a look and see if there's, I might make similar problems on here or something like that. But for the most part, it'll be essay ones. And similar to what we had in the textbook problems, and more along those lines of actual writing out stuff. I'll get that out by tomorrow. I'll try to get it out by noon. By noon tomorrow.
Will it be like timed or anything like that?
No, you have a week to do it. Yeah, you'll have at least a week to do it. No, there won't be a time when you start on it. It'll just be a Word document, a PDF document.
Oh, that we can like print off or write notes and stuff on. And
yeah, and that's so you can actually fill it in or write on it and scan it or take pictures of it. However you want to do it is fine. But I will put that on. So I'll do the exam. It's not going to be terribly long. I mean, this is going to be probably let's say 3 to 5 questions, and they'll be similar to what we talked about, either on the handout or in today's stuff that we went through. Probably more along the lines of what we talked about today, and it would be more like scenarios. This person, their uncle does this, or their, whatever. They own stock in this company, whatever that is. So it'll be more. What am I doing here? I'm talking to a wall. So it'll be more along the lines of a scenario and saying, comment on this. Is this a violation of independence or whatever? And I don't mind, doing discussions of it is, because again, some of them aren't going to be, it isn't 100% sure of what it is, what it necessarily is. So, but point being is that your answer may not necessarily be identical to someone else's answer. You may get all the points for it, depending on how you answer it. So if you say, well, thinking about this scenario or that scenario could change it, that's fine too. Any questions on that? Okay. Well, I will get that together again. Probably more along the lines of essay, and I'll say probably more, probably 3 to 5 questions. I'm probably leaning more towards 5, maybe 5 shorter ones rather than 3 longer ones. So something like that. But I'll get that out to you guys. It'll be in your mail by say by noon tomorrow. I should have it all.
all right, thank you.
Any questions?
Okay, thank you. No.
Guys, all right. Have a good evening, and I will have the drops for that homework up shortly.
Okay.
All right. Good night, guys.
Bye. Good
All right,
night.
thank you.
Bye. Good night.
Good night. Thank you.